ASML is a company that has seen great growth over the past 5 years, so when we compare it to the broad market, you can see that it has greatly outperformed it. Now what you have to consider is that always when a company is trading overvalued, in the long term it will drop in price. So comparing ASML's PE ratio to its historical 5-year price, we can see that when the PE ratio was fairly low at 29, the price rose. And then when the P ratio was high at 63, the price dropped. So in 2024, when the PE ratio was sitting at almost 60, the price of the company dropped. Now currently the PE ratio is sitting quite high at 38, which would be considered overvalued. Though what you have to understand is that ASML is a premium company with very high growth in profits, which might justify its high price. So jumping straight to our stock valuation spreadsheets, let's figure out if ASML trading expensive is justified. We will plug in the ticker and wait for all the metrics to show up. Now as always, if you enjoy these valuation spreadsheets and find them helpful, you can download them at the link in the description. Now right away, let's have a look at ASML's dividends. We can see that they have a low dividend yield of 0.89% with a low trailing free cash flow payout ratio of only 36.21%. And the lower the free cash flow payout ratio, the better, as after paying out their dividends, the company still has a lot of free cash flow left over to direct into innovation, which is especially important for companies such as ASML, which are in the technology sector. Now jumping straight to the 9-pillar analysis, ASML gets a rating of 7 out of 9 with 2 pillars in the red, and these 2 pillars are the 5-year price to free cash flow and the 5-year PE ratio. So if we zoom into pillar 1, the 5-year PE ratio, we can actually see that over the past 5 years it has been moving between 30 and 45. So the fact that their current PE ratio is sitting at 41 doesn't necessarily mean that the company is overvalued compared to the earnings they generate, as historically the company was always trading at around 40 times its earnings. Now this is not the same case with the price to free cash flow. If we have a look at pillar 2, we can see that for most of the past 5 years it was sitting nice and low, but in 2024 it jumped up to 97 and currently it is sitting at 89.21. And the main reason for this is actually the decline in the free cash flow. If we zoom into the free cash flow, so pillar 5, we can see that from 2022 it dropped from about 10 billion to only 3.2 billion in 2024, and year over year it dropped by another 12.68%. And so with a similar amount of shares but much lower free cash flow, the free cash flow per share has skyrocketed. Now if we jump to the 9 pillars, we can also have a look at the revenue growth over the past 5 years and the net income growth over the past 5 years. If we zoom into pillar 3, we can see that the revenue has actually been growing very well over the past 5 years, growing from about 12 billion in 2020 to 27.5 billion in 2024. And that is the similar story with the net income, which has grown from 2.5 billion in 2020 to 7.8 billion in 2024. So the overall profits of the company are growing, but they just had a big drop in free cash flow over the past 3 years. So overall ASML seems to be quite fairly valued compared to their historical earnings, but they are currently overpriced compared to the free cash flow they generate. Now one thing I really like about the company is their decreasing shares outstanding, sitting at a rate of 1.36% yearly. Now what you have to understand is that decreasing shares outstanding are extremely important for the company. If I jump back to pillar 1 and scroll down to the earnings per share, we can see that they have been growing a lot over the past 5 years. This is of course thanks to the growing earnings, but it is also because the company has been buying back shares. With less shares outstanding in the market, more earnings can be assigned to every single share, therefore raising the EPS exponentially. And so if ASML keeps decreasing their shares outstanding, their earnings per share will grow and their 5-year PE ratio will decrease, growing the company's value. Now what a lot of investors, including me, like about ASML is their high and growing 5-year profit margin. If we zoom into pillar 6, we can see that the ASML's profit margin has grown from 21.9% in 2020 to 28.4% in 2024. And of course, with a higher profit margin, the company will be able to generate more net income. Now, another thing I like about ASML is their low long-term liabilities. If we have a look to the 9th pillar, the long-term liabilities over the 5-year free cash flow negative dividends, we can see that this ratio is sitting at only 0.31 for ASML, which means that they can pay off all their long-term liabilities in about 2 years, which is awesome. and means that with the low free cash flow they currently generate, they would still be able to pay off all their long-term liabilities and so not get into financial stress. And finally, let's move to the consecutive dividend growth, which for ASML is sitting at 10.78%. If we jump closer to pillar 8, we can see that that is more than double the average stock year-over-year dividend growth, and this certainly makes up for the company's low dividend yield of only 0.89%. So overall, it seems like ASML is doing quite well, and with the booming AI and chip market, I do believe that they will grow a lot into the future. But let's figure out if they are actually trading at their intrinsic value. So first, jumping to the grams formula revised, I will plug in the high earnings per share growth at 24%, medium at 18%, and low at 10%. I will then average that out with the analyst projections and get a 5-year earnings growth estimate at 21.52%. Now, as the current yield on AAA corporation bonds is very high compared to the short-term average, I will plug it in at 4 and we will get an intrinsic value of $658.85, which is 13% lower than the current trading price. Now, for the second valuation model, we will jump to the discounted cash flow model. We will plug in the free cash flow over the past 5 years and calculate the future growth rate of 17.3%. We will use this to calculate the future free cash flow, and plugging in a discount rate at 9.3%, we will calculate the present value of that future free cash flow. We will then sum all of that up, add cash and cash equivalents, and subtract total debt and get an equity value, which we will divide by the shares outstanding and get an intrinsic value of $838.54. Now, for the third valuation model, we will compare ASML to 2 of its competitors, Applied Materials and Lam Research. We will take these companies' current stock prices and divide by their earnings per share to get their PE ratios. We will then average these out and multiply by the high earnings per share of ASML, but still get an intrinsic value of only $412.35. And this is because of the low PE ratios of the competitors. The average PE is sitting at 22, while ASML's current PE ratio is sitting at 40, and therefore the intrinsic value comes out much lower than the current trading price. Now, moving to the final dividend discount model, I will project the dividend growth rate of 8.5% into the future, and combining that with the discount rate of 9.3%, we will get an intrinsic value of $818.91. And finally, moving to the ultimate valuation, we will average out the 4 valuation models and get an ultimate intrinsic value of $682.17, which is 8.3% lower than the current trading price. And with a margin of safety of 15%, we would get an acceptable buy price at $579.84. Now, if we have a look at the 6-month chart of ASML, we can see that over the past 3 months, the company has been trading below its intrinsic value of $683. And so if you want to add ASML to your portfolio, you might want to wait for it to drop below its acceptable buy price of $579.83. And with that, if you did enjoy the video, make sure to leave a like and subscribe, as it really helps me out, and let me know down in the comments if you are buying, holding, or selling ASML.